thanks again for hosting this event. Also want to thank all the callers for logging in and joining us for this webinar today. I really found it a great pleasure to speak with you today. Today is really just a follow-up from the discussion that we had last week. And some of you might have been on our call and some of you might have not been. But what I will encourage you is that to review that and go on Bridget's website and log on and see the discussion, because that would be a good foundation and building block for some of the things that we're going to talk about today. And when we was thinking about doing these series of webinars that really focuses on retirement and retirement readiness and plan design, we really had the HR professional in mind as well as their employees. Because we have been, in our discussions with HR professionals, we had found that they are seeing different challenges with their employees with having proper income replacement once they're retired. So we want to make sure that everybody can retire on their terms in the way they want to retire. And so there's been a lot of changes just in the retirement space over the last recent years. And some of those changes deals with fiduciary support, technology, and fee structure. But what we really want to hone on, we think what makes the key difference in being a successful plan versus not a successful plan is really having the employees empowered to retire on their terms. And so today we really want to focus on that. I have with us one of the powerhouses in the industry with Zach. Zach is a consultant with Principal Funds, and at Morgan Stanley we have exposure and access to so many different companies and tools, and Principal is one of those companies, and we could have chose anybody to actually provide service and insight on this topic, but I specifically targeted Zach because of his expertise and his knowledge of the industry, but also because of what Principal stands for and the resources that they bring to the table. Principal, again, is a powerhouse in the industry. 90% of their assets come from retirement plans, and that is much higher than the industry average. So they're well equipped to meet the needs of smaller companies and larger companies and everything in between. And that's their core focus, I should say. And so I really want to just open up and let Zach, I don't want to take any further time from him, but he's going to provide that foundation support to let you know how your employees can be empowered in their retirement plans and how you can support them in that endeavor.
Thanks, Terrell. The whole purpose of today's presentation is going to be what can we do to help drive participation and improvements on retirement plans, or what is the outcome going to be? Obviously, with retirement plans, the one thing I typically hear in the marketplace is it's confusing, and you have all these words that you can see on the screen that is probably gibberish to most of us. So rather than looking at all the clutter that's out there, one of the things I always have to go back to is what's the main reason why we set a retirement plan up for? And the first thing is going to be is it's for a tax shelter for most of us. And the second thing is so that employees can leave the workforce at some point. And what that takes is not just a amount of money, it takes a replacement ratio. It takes money and a paycheck for the rest of their life. So ways that we can help drive that, or at least understand where we're currently at, is how do we define success? And the reality is, if you look at really a participation rate from early 2000s even to where it is currently today, it's really been untouched. The participation typically stays right in around 80%. I would actually argue the smaller your plan typically is, the less participation you have. I actually saw a statistic just recently that was saying that plans under $1 million have a participation rate of around 30%. So depending on where you're at with that, I would say your larger companies are dragging this participation higher, because now we're seeing more and more options on large plans of auto-enrollment or auto-escalate. Now, the one thing that always catches my mind, though, or my eye, is the fact that the deferral rates have actually been untouched pretty much since retirement plans opened up. So the first retirement plan was opened up by T.A. Krebs, and I believe it was, I want to say 1952, and they had two options inside, an all-cash option and an all-stock option. And the deferral rates around that time was 5.5%. So if you look at where they're currently at as well today, the deferral rates are still hovering around 5 to 5.5%. And you'll find that for most of us, the driving factor of what we have in retirement is A, time, and B, is going to come down to deferral rates. So we got to figure out a best practice of how do we get employees engaged at a younger age, and how do we get them to the right amount of money to save for retirement. This is like showing the confidence level of how much money somebody's going to have in retirement, or how much confidence are they going to have a relaxing retirement where they can live the same lifestyle as they do today. And actually, this is a little, to me, I think it's, I'm shocked by how high the numbers are on very confident. My background is actually working with employees one-on-one and to help them understand their retirement, what they're investing in, how much they need to put aside. And I probably did close to 5,000 meetings in the last 7 years with employees. And the reality is I probably have a handful of those individuals that are actually on track for retirement. So I would say the reason why it seems like it's higher than what I think is probably the right number is because most of them have not played out in their mind how much money are they going to need to replace during retirement. Most of them understand that there's going to be a pile of money sitting there, but they haven't actually played out what does inflation do to this? What happens if the market goes up and down? How much is the proper amount that I should be withdrawing on an annual basis and not have this money run out? And now with longevity, it's hurting us even more. I mean, I'm sure a lot of us either know somebody or have a grandparent that's actually been in retirement for over 30 years. So most of us are not taking into consideration the length of retirement now. How do participants project the funds needed for retirement? Well, most people I would say we talk to are hopeful they're going to have enough money, or they just ignore the issue because they just think they might have to work forever, or they're guessing. And the other option is planning. And we know those that plan have a 46% better option to be able to have enough money for retirement than those that don't. So we would be really pushing on this situation to make sure that you're planning, because most individuals are not currently doing that. And you sit down with a financial advisor, or go down and sit, if you don't have time for a financial advisor, or you don't have the funds for something like that, at least run a calculator of options to figure out where you're going to be at for retirement and how much money that's going to take. When I say income replacement ratio, it just means is how much money is somebody going to need to replace during retirement. And conventionally, we're looking at anywhere between 70% to 75% replacement during retirement. So if you think about what you make today, and let's just say that the individual is making $100,000 just for simplicity reasons, during retirement, that individual will need to replace at least $75,000 to live a similar lifestyle. Some would argue that that's even on the low end of it, because most individuals are not paying off their homes like they used to, meaning they're going into retirement with hefty debt. The repayments, you're always going to have a car payment. Maybe medical bills are a little higher now than what you expected. So some would say 75 is actually on the low end, and I would probably agree with that. And it all comes down to how do you define your retirement. This is an interesting statistic. In 2011, 64% of plan sponsors surveyed feel that they were responsible to have their employees or have interest in making sure that they're on track for retirement. And that they feel like it's their responsibility that their employees are up to date on understanding their needs for retirement so that they can lead. I think one thing that we're commonly hearing right now is with ACA, that's probably top of mind. And I wouldn't argue that that shouldn't be. The challenge that I see, though, is that Affordable Care Act or having affordable insurance or health insurance is always going to be top of mind, because the reality is if we don't take note of where people are currently today, and we don't take the right proper protocol to have enough money for retirement, they're always going to be on your payroll. They don't have enough money to walk out of the door when it's needed, and it's going to drive our healthcare costs even higher. I think I saw there was a statistic out a couple of weeks ago that said that the average employer is spending $12,000 a year on having health insurance per employee, whereas the average contribution rate within a 401k plan from an employer per participant is coming at $2,500. Well, although I think health insurance is obviously important, it should be equally as important to have enough money to help that individual have enough money for retirement as well. So how do we know if participants are on track for retirement? Most of the 401k providers in the marketplace probably have something that can help you track what their current plan is looking like. If you have any questions, I'm sure Darrell can help you with that as well. He has tools like this, or at least can go to a vendor to get these as well. What we do is we can put all the information into a spreadsheet and figure out, where is everybody in the current plan, what's their deferral rate, what's their date of birth, and with Social Security, what's our expectation of those individuals having Social Security at retirement. And it actually gives us an output that shows us how successful is that plan. So it takes it on a plan level. We see this a lot. We're hearing a lot more of this, of employers coming to us and asking us, is my plan on track, or are my people doing all right? And more times than not, we have to tell them, no, actually, you're going to need to help them a little bit more. Doesn't mean that they have to put more money in. It just means that maybe we have to help them modify behavior. So, like I said, what you can do is to figure out the replacement ratio tool. It helps you identify if the participants are on track for retirement. The other thing is defining their goals. What do they think this should be a successful plan, not a popular plan? So what's it going to take to get there? And really what it's going to come down to is creating enough analysis for us to put it together so that we can develop and give you a output that will help you. And if, like I said, and then that way we can get your financial advisor involved to help us implement different plan designs. So the possible solutions we have here is education, plan design, or even looking at non-qualified deferred compensation. On a plan design level, ways that we can help the employees finish well is we can implement things like a safe harbor. If you're currently going through a plan design where you're failing your ADP or ACP testing, I'm sure your TPA or your provider is telling you this annually, and ways to fix that is you can implement a safe harbor plan, which allows your highly compensated individuals to put more money aside. It also will help everybody in the plan contribute or get some tax-deferred dollars from their employer. There's things like automatic contribution arrangements. I'm a big fan of this, auto-enrollment. I understand it doesn't work in all scenarios. However, what you're going to find with auto-enrollment is that it will drive the flow into the plan. We actually had a study where you had everybody put in, we did it on 2,500 plans, where we had everybody start at 6%. And we allowed the employee, if they didn't want to contribute at 6%, because it seems a little hefty, that's fine, they could actually go in there and opt out of it. And the way we looked at it was they allowed the employee to opt out of their own success. And when we did that, we found that 80% of the individuals actually stuck inside the plan. They went with it. We went a step further and we said that, what if we did auto-enrollment, or auto-escalate, excuse me. So we're at 6% today, and 1 year later, on the anniversary date, it goes to 7. The following year, it goes to 8. So we understand we can't get somebody to save at 10 to 15% of their paycheck right out of the gate. Not that easy. However, if we can do it little by little and make it easier on the employee as they get paycheck or get pay raises, and hopefully that can help offset so they're not adjusting to their new lifestyle with the pay increases. We found that 80% of employees will stick with that as well. So in other words, now what you're doing, instead of trying to educate everybody within 30 minutes or whatever the time that we might have, we're actually modifying more behavior. It's the one benefit that we actually make people enroll in, and the inertia is the number one reason why plans are typically not successful. I could look at my own family and tell you that the main reason why they may not have enough money for retirement was because they didn't know how much money they needed for retirement. They didn't know what investments they should use to invest their money in, and no one's had proper dialogue with them until they're in their 60s. So if we started getting these things in line, more individuals will be able to retire on a timely basis.
Hey, Zach, this is Jarrell. I had a quick question about that.
Yes.
If you had to, like, save one of those key bullet points on there, which one do you think may be, like, the easiest to implement for companies?
hmm Well, the one that's not on here that and I was just going to actually start going into that is a default option using what we call as a qualified default investment alternative, better known as QDIA. And it just means that if the employee doesn't make an option of where their money is supposed to go, it's going to default automatically to this investment. And that's typically either a balanced investment or a target dated fund. And in the past, we never had a qualified default investment alternative, and it ended up putting money either in all in cash or all in stock. And what it's done is it drove individuals from saying, well, I don't know how to invest my money, so I'll get to it later, and then they end up 5, 10 years down the road. I would say that would be the biggest driver on allowing those individuals to have peace of mind. It's the 1-second solution, in other words. At least they're doing something than nothing. And if you're going to follow up closely, auto-enrollment would be my next one. And the one thing we got to be careful with auto-enrollment, however, is that we're not auto-enrolling them at something that will not have enough impact at retirement. We were seeing that a lot right now. The typical enrollment is around 3%. Although that sounds great that we're getting them to do something, the issue that we're still having is the employees are typically saying, well, my employer told me to put away 3%, I feel that's enough. And now we're getting 25 years down the road, and they're still at 3%. So I think when we're selecting the proper enrollment, we need to take in consideration, are they going to come back and increase, or should we look at doing this on a plan level where we're automatically increasing it for them? And if they want to opt out of any of these, they can. They just have to go online and do it, unlike the way we have it today where we're forcing them to actually go online and to enroll, where it's not happening. The other thing that I would suggest is looking at, I was actually working on a hospital just recently that I did some consulting with, and their question to me was their plan felt like it was a little bit of a failure. They've had it open for 4 years, 400 employees, and only 150,000 it was sitting in the 401k plan. So my first question was, do they have auto enrollment? They said no. Second question is, what's your match? They were doing 100% for the first 1%, which by human nature, we typically look at what is our employer going to contribute, and we'll typically go at that to get our free money. Well, what if we could stretch the matches? So I said as a suggestion, why don't we do 25 cents on the dollar up to 4%? So in other words, it's costing the employer nothing more. They're going to still put in the same 1% like they've been doing in the past. The difference is now we can get human behavior behind us to start putting in more money. So the employer says, well, that's a great idea. And then I said, well, the next step we're going to do is we need to auto-enroll everybody at 4%. Because if they don't want to get the match, they can choose not to. However, more times than not, they will stick with it because they know they're getting free money on the other side. So as a suggestion, look at where your matches are at and see if there's ways that you can stretch the match out. Statistic after statistic, smart plan design does work. It will drive outcomes. There's a great book out there. It's called Save More Tomorrow. If you have not read that, I strongly suggest you do. It's going to talk about the behavior of saving for retirement. And the point of the book is really to explain that if we get them to start in the plan as easy as possible and squash inertia, there's plan design levers that will help increase so that the employee gradually through time will have enough money for retirement. Education goes a long ways as well. If you have a plan provider that's offering you education or a financial advisor that's currently on your plan offering education, take them up on that. What I found is that when you go into a room and you give a group presentation and we're talking about things like mutual funds and bonds and stocks and whatnot, we tend to get the glaze over look. But if we actually sat down with the employee and explained to them that this is where you're currently at and this is where we need you to get, because one or two things has to give. Either the lifestyle has to change before 65 dramatically, or we got to start saving more money today. And once we can actually play that in dollar amounts, if they're used to making X dollar amounts and they have X amount in debt, the question is what's going to be changed between today and maybe 10, 20, 30 years down the road, depending on who we're talking to. So I definitely think participation or working with participants one-on-one is a big deal. Group meetings can work. Obviously, we got to get everybody on the same note, which is always tough to do, but it's always a good option to have at least annually, if not semi-annually or quarterly with your financial advisor.
Hello, Zach. I wanted to
A lot of our
Yes, I wanted to ask her a question real quick. Actually, I have a question from Diane. She said our company is potentially looking at profit sharing. What is your view on profit sharing, and how would you implement that program?
Yeah. Profit sharing is the easiest thing to do nowadays because in the past you actually had to have two separate 401k plans and a profit sharing plan. Today you can actually have everything as one. So it's really just a component. You actually can go to your TPA or your plan provider, whoever it might be, and ask them if they have a component of a profit sharing that they can put in place. I definitely believe that's a great place to go because it's going to give your employer, if your employer had a good year and they want to share that money with the employees, I completely agree with it. That's a great way. It's all tax deductible for the employer, and it's going to be a great feedback or a good feed for the employees to get additional funds. So best way to implement it is just talk to your TPA or when I say TPA, that's your third-party administrator, or your plan provider, depending on who you're with, whether you went with a bundled solution or unbundled, and they can implement it. And it can help you save a tremendous amount of money, and your employees will be very happy with that. A lot of plan providers also have good technology out there where you can go on there and plug in your numbers of how much money you have today and put a calculation in there to what you're going to have tomorrow, and it'll tell you if you're on track or if you're behind. And you can put additional outside assets in there into the calculation. And I know at Principal, I don't know, I can't talk to any other providers, but when we do this, it will link up with their quarterly statements from us. So in other words, when every time they get it every quarter, we tell them if they're on track or if they're behind. And we also go as far as telling them, here's the improvements you need to do. You can do an auto enrollment or an auto escalate for 5 years, or we need you to go to 7% today, or whatever it might be. But at least it's giving you direction, and it's consistently staying in front of you. I think I'm covering this page pretty well, going through calculations, writing down a game plan, going online and doing a game plan. I mean, there's great websites. Even CNN Money has a good website. You can run all the calculators you want, going to seminars, and, of course, talking with a financial professional. That's one of the driving factors for a financial professional is to help you understand your budget and how to save for retirement. Most individuals, I think, are looking at a financial professional of, well, I have to have money to deal with them or whatnot. Well, the reality is that they should be more of a coach to help you understand what is needed to have an outcome that's successful for retirement. Now, I'm going down the weeds a little bit when I bring up non-qualified deferred comp here. The way to think about non-qualified deferred comp is you have some probably very successful individuals within a company that make a tremendous amount of money versus everybody else. And the question is at the end of the year is how do we allow these individuals to save enough money, because it's all about income replacement. If you make more money, you're used to living off of that, and how do we replace that at retirement? And so what non-qualified deferred comp does is it's unqualified, meaning it doesn't get the protection that your 401ks or 403bs have, but it goes up and above it. It's like an add-on, and it allows the employees, and they can discriminate, meaning you can have just the highly comped in there or your C-suite in it, and it allows them to put away more money and on top of the 401k plan, and they can discriminate so they don't have to allow everybody into the plan. That's the benefit. And we see this a lot. What will happen is if you have individuals that are making $500,000 or above, and the question is, do you add in a profit sharing, or do you add in a safe harbor, when really what they're focused on upholding is the top earners? And so they might implement a non-qualified deferred comp plan before they even do a safe harbor. So it all comes down to plan design. And this is the gap I'm talking about. It's showing you, obviously, we know Social Security is going to pay X amount of money. 401k is going to pay X amount of money. And if you're used to making X, $250,000 a year, and you're going to try to live, customized to that same lifestyle, well, there's going to most likely be a gap because 401k and Social Security is not going to allow you to save enough, and that's where non-qualified deferred comp can come in and be that additional gap filler. 3 takeaways for today. I would consider, well, how do you define success? If any of you really sat down and talked about, on our plan level, what do we think is successful? Or do we just have a plan here that's just a popular plan, and if they contribute, that's great? The problem is with that is that, like we said at the beginning, there will be a day that you're going to have to keep enrolling or keep employed some individuals that are in their late 60s just because they don't have enough money to retire off of. So how do we define success on a retirement plan? Reach out to your financial professional. Find out if they're on, what are they doing to help move the needle on your retirement plan? Is it going to take education? Is it going to help by modifying the behaviors, by using things like auto-enrollment, auto-escalate, or using a qualified default option? And then, of course, evaluate your highly compensated employees. I can imagine if you're one of the HR individuals and you found out that your CEO just got a check back at the end of the year because you failed at testing, or the 17.5 is not going to be enough for them to put aside for their contributions for the year. If there's additional needs there's options out there. There's vehicles like the non-qualified deferred comp that can help you complement your 401k plan. At this point, I'll just go ahead and open it up to any questions that you might have.
Yes.
I had a quick.
No, go ahead, Jarrell.
Zach, to your last slide when you was talking about success, I guess that probably can vary based on the company and the size. I mean, what would you tell me are some good thresholds that they can meet in some of those various categories? Or, specifically, when they saying if their plan is successful or not, how can they benchmark that?
Yeah, so kind of like the replacement ratio tool that Principal has, for example, what it does is it takes everything on a plan level, so we have an idea how much every employee has in their account, how much money they're putting aside for their deferral rate, and how much longer they have before they actually retire. Now, I understand there's some money on the outside that we're not including on that, but more times than not, it's typically what's in a 401k plan. So what we do is we kind of run this through a spreadsheet, and it tells us the outcome. So I would say your goal, you're not going to help everybody, but one of the top goals you should have is to have over 60 to 70% of the employees in your plan have enough money for retirement. So, and it's well below that. Currently, I would probably say it's probably closer to 10% of employees are actually on track for retirement. And we're not running enough of these numbers. And then that's the typical issue we're having, and that's why it kind of has to come from the plan sponsor level versus going to each of the individuals one-on-one. First of all, it's tracking everybody down is the challenge, and second of all, is to get them to listen. But if we can at least get some buy-in from the plan sponsor level, where they're actually taking note that we only have 10% of our employees on track for retirement, what can we do to modify that? So to your question, yeah, I would say you got to look at what's your average deferral rate. How much money are they going to actually have at retirement? We can run those numbers with the calculator that we have here. And sitting down with your financial professional to see if there's group meetings they can benefit from. Do things like even debt reduction. I would say that's probably the number one driver on why individuals aren't contributing to the plan is figuring out where they stand with their debt and maybe having a seminar around that.
Okay, and this is a follow-up question. This is a follow-up question for Diane. She was asking about profit sharing a little bit earlier in the workshop. She wants to know, is this something that can be leveraged just only for certain employees like our executives or managers and not offered to the full staff?
You have to offer it to everybody, but there are ways with a third-party administrator that you can change your numbers a little bit. They can do things like new age comparability, which allows the profit sharing to put more money to either the individuals making the most money in the company or to their age. So there are ways to change them. I don't want to use the word skew, but there are ways that we can be flexible, but you're never going to completely cut everybody off of it because you can't discriminate within 401k plans.
Okay. We also have a question about auto enrollment. Do you find auto enrollment a hassle for those that do not want to be enrolled, as far as refunding employees for the portion they have invested?
Yeah, I think there's a certain spot where auto enrollment works, and there's a certain spot it doesn't. If you have high turnover, I would probably get behind you and agree that auto enrollment's not going to work for them. For one, it does drive up plan costs because what companies are looking at is what's the average account size and what's the total assets under management as a plan level. And the lower your average account size is, it could drive up your cost on your plan. So the reality is yeah, there could be a spot on there that doesn't work. However, I can tell you we have a client. It's a pretty large client. It's a blue collar. They're in manufacturing, which most people say, well, it doesn't work for them. Well, we did auto enrollment and auto escalate with them, and it's a 1,600 person plan. And we found that when we did this, their average deferral rate at this company right now is 9.5%. We know those individuals are going to be on track for retirement. I mean, that's phenomenal just by doing the auto enrollment and auto escalate. So to the question you asked, yeah, I think it could be a hassle for some if you have high turnover. But that's why if you actually have them go online and opt themselves out before that happens, that is always helpful. Otherwise, it may not work for your company.
Okay, I don't see any more questions. Gerald, did you want to add anything to anything that Zach has said about the program at all?
Zach, one of the other things that because we're talking about employees moving from, focusing on transactions to really being more behavior-based and having opportunity to modify their behavior. What's a good timeline that companies can expect to get buy-in for some of the suggestions that you've given today?
Well, I think, a few things that work is give them a picture of where do they want to be in 30 years and what have they done to get there. And I think the reality is many of us haven't done enough. And the other thing is I would say that if they haven't done a calculation, I think it's going to be pretty eye-opening to them when they start taking into consideration if they're only putting in 2 or 3% on average of their income. They need to think long-term on how long will 2 or 3% of my income, putting aside, how long does that last me during retirement? And then also taking consideration that longevity. I mean, we're living 30 years into retirement now. I mean, it's the reason why Social Security is not working. So, I mean, I don't want to take a scare tactic or anything, but this is reality. Is most of us would probably say that, will Social Security be around? Some say yes, and some say no. I bet a lot of us say no to that. So the next question is what are we doing to help our own situation? And then to keep in mind that, Israel, you might know this number better than I, but I want to say it was like 62% of employees leave work without it being their option. In other words, either a sickness happened to them or they got put out a little bit too early into retirement, and they end up, really just trying to get by at that point. So a lot of it's not our decision on when we leave for retirement. So we got to take into consideration what are we doing in current day that's going to impact my tomorrow. And that's why I think if you take things off the table, like put things on the table like auto enrollment and using an automatic default option where money is actually getting put in based off their age and their risk, that's going to help squash the inertia that they currently have. So I would just say, look at the statistics on it. We know that Social Security is going to have some type of overhaul, and if you have plans to either retire or retire on time, what are we doing to make sure that we are supplementing our Social Security or supplementing our entire paycheck?
Gotcha. Zach, another question I want to ask you, just because there's been a lot of conversation around the Department of Labor and some of the changes that have been going on with the Department of Labor around fee disclosure, also with the Department of Labor increasing the amount of audits that they're doing on companies right now. Now, what are some things that what are some of the trends that you see just in the retirement plan space, but what are also some of the things that companies can do to protect themselves to make sure that they're properly structured from their retirement plan?
Yeah, Department of Labor is definitely taking a very close look at retirement plans now. They really didn't even have an overhaul on any of this until about 5 years ago, where they started putting their hands in that. So now you have to worry about IRS, Department of Labor, and ERISA. And what we're seeing right now is the fines are definitely picked up. I mean, between 2000 and 2010, there was something like $250 million worth of penalties. Last year alone, in 2013, there was $1.7 billion. The year before that, it was $1.3 billion. So I think the reality is, if you look at really where our government is at as far as trying to collect more in income, well, a good way to do it is penalize those that we haven't done before. And it's not necessarily saying it's a bad thing. There's a lot of lawsuits going on. We have one in our backyard right here in Charlotte right now. And the reality is with that is it's helping compress fees. I would say that in the past we've had some excessive fees in some areas. And what it's doing is now with what we have a document out there, if you may not know this, but it's a document called the 408B2. And the Department of Labor says now we have to come out and tell you every year what your expenses are on your retirement plan. And I think it's the best thing that's happened to our industry, because it's finally putting things in the market that, for one, it's picking up and saying that, well, now you can see what the plan down the road is, what they're charging or what the advisor is charging. And it's really helping the market get back in place. So things you can do to keep yourself online or to keep yourself in check is, first of all, I would do an annual fiduciary review with your advisor and your plan sponsor, meaning that they should have a booklet or some type of seminar ready for you where you can talk about your plan specifically. What's our enrollment look like? What's our deferral rate look like? Where is the majority of the money sitting? How do we make improvements on this? Also checking the boxes saying, every couple of years you should do a plan benchmark. Review the plan costs, the fiduciary sides of it, what's the provider doing to help improve our outcomes, and what are they doing to help keep us out of trouble, meaning are we 404C compliant? Are we using things that the Department of Labor gives us blessings on, like a qualified default investment alternative? I would say there's a lot of things you can do, especially when you sit down with an advisor or a plan sponsor that say, what are we seeing? Well, we're seeing penalties in excessive fees. We're also seeing a lot of penalties on coming from like third-party administrators, meaning that the administration part, they're failing ACP or ADP testing, or they're not filing a 5500. You got to make sure you know your third-party administrator very well, because they're the ones that will keep you out of trouble. So if you don't know them, it's something you might want to do is call out to them. If you feel like you have some questions about your third-party administrator, make a phone call out to Jarrell. I'm sure he has some information he can share with you or help you sort out any issues you might have with them.
Okay, I do have a follow-up question again from Diane about profit sharing. She's really wanting to know about this. She's asking about money purchase plans and cash balance plans. How are they different from profit sharing?
Yeah, profit sharing is actually a portion of your income at a company. So let's say your company was very profitable and you wanted to share that money with your employees, you'll do what's called a profit sharing with your employees. It's within the 401k. A money purchase plan or pension plan, now the old pension plans that everybody's typically used to is like the John Deere and the GM, those monster retirement plans that we're pretty much not seeing anymore. But we're still seeing a lot of smaller defined benefit cash balance plans, which means that companies like lawyer firms and doctors are using. What it allows a doctor or a lawyer to do, I'm just using them for an example, is it allows them not to just put away their 401k money, but it also allows them to put even more money in on a pension or a cash balance side. They can actually go all the way up to $210,000 on top of their normal 401k. So the difference is sitting down, and I typically, you can do this through any plan provider out there or a third-party administrator. And what they're going to do is build a plan design that's best for your company, and it will actually take each individual in there, and it'll tell you how much they can put into the cash balance plan. Now, the one thing I will say, if you're going to have a cash balance plan, you need to keep funding it. It's not a one-and-done type situation. It can be an absolute headache, and most of the third-party administrators or pension or the providers out there will say you need to make sure you're going to fund it with X amount of dollars, maybe $150,000 for everybody, for at least 5 years. We can't go back on it because it's a red flag as soon as you've only done it for 1 year. It makes it look like you just used it for a 1-year tax shelter. But there's there's nothing. A cash balance plan is a pension. It's completely different. It's called a defined benefit. A 401k plan is a defined contribution, and that has the profit sharing.
Can the
Does that make sense?
I'm sorry, we just wanted to get this. Go ahead.
I'm sorry about that. I was going to ask you also with that. So if I have a down year and my profits are not that high and I have a profit sharing plan, I don't have to contribute, do I, or do I?
No, you do not. You are correct. It is discretionary.
And for the cash balance plan, unlike for the profit sharing that you said you couldn't discriminate who you can offer this to, can the cash balance plan be offered to a particular employees, or is this something that you have to, if you offer it, you have to offer it to all your employees?
You have to offer it to all the employees. However, they look at it more like, think of it like time value of money. And so you might have somebody who's 50 years old and they're the doctor, the main doctor there. And everybody else is around the age of, we'll just call it 30, 35. And since the doctor doesn't have as much time as the individual who's 30, they actually will allow the doctor to put in that much more money. And what they do is they do the time value of money of X amount is what you can put away at retirement. So it can be, I don't like using the word skewed, but it's, once again, it gives flexibility to the individual who's either older or makes more money, puts them in a different group than everybody else. But once again, you can't discriminate necessarily. It's just the way we build the plan design. I'm not a plan design expert when it comes to that. A third-party administrator is typically where I go to have them run an illustration. And that's where we can come back to the doctor's office or lawyers and say, here's what the plan design looks like. Is this suitable for what you were looking for? Is this how much money you were seeing yourself put aside?
Okay. Well, we have about 15 minutes left. Some of the questions that were asked were absolutely perfect. Some of the I'm learning a lot myself, so it's very, very great that everyone's asking some questions. And if there's any more questions, I urge everyone to use their text box for questions and type their questions at the bottom of your panel. If not, if there's anything else that you need to add, we do have about 10-15 more minutes left. If not, we can end early. But other than that, we've covered some great ground with retirement plans.
Yeah, the one thing I think I would urge everybody to think about is, although I think fees and funds and fiduciary and all that information is very, very important, I do believe that you get to a point where it's all commoditized, meaning most of us, all the providers in the marketplace, are going to have open arc as far as what our investment selection is for you. We should all be covering, and I know for us, we do annual fiduciary reviews. Your client, your advisor should be doing an annual fiduciary review with you on your plan. You make sure you have a fiduciary folder. If you don't have one, get one, just in case the Department of Labor walks through your doors and wants to see of why you have certain procedures the way they are. At least if you notate it, that's what they want to see. If you haven't repriced your plan recently, just an FYI, we have seen a huge compression of anywhere between 30 to 40% of compression in pricing in the last 4 years alone. So we're seeing it come down market, and we really urge everybody to review that at the very least. But then also take in consideration what's our what was the reason, what was our objective for setting the retirement plan up in the first place? And if we're not hitting that objective, why do we have them open? So what I mean by that is we want to make sure the objective is having a healthy retirement and a tax shelter for everybody.
Exactly. This workshop will be online. It is being recorded. We do put it on our YouTube channel. We also put it directly on our site under the past workshops tab that you can click on and review this workshop if you wanted to go back to review some of the answers to the questions. I will be sending the contact information for Zachary and Gerald in your follow-up email. So if you have some questions directly that you would like to ask them, I have their not only their contact information first, their email and their phone number, so you can reach out to them directly. Thank you again for your time. Did anything that you needed to add, Jarrell?
No, I think we covered all the bases on everything.
Okay. At the end of this workshop, there is a survey. I really do ask that everyone takes the survey. It's only anywhere from 8 to 10 questions that's going to ask you about our speaker, how we did, some things that you'll like to see in the future, not only in retirement but in general, that we can tailor some workshops to. Please provide some feedback. Again, this will pop up once you log out of the workshop. It's a 10-question survey on how we did. And again, everyone will get the contact information as well as the copy of this workshop in our follow-up email. Thank you so much for your time, Gerald and Zachary. I really appreciate that, and look forward to any questions directly from our attendees. Thank you.
Thank you. Appreciate your time.
Thank you.
All right. Bye-bye.